All right, let's be honest. Picking a mutual fund can feel, well, pretty overwhelming, right? Today, we're going to cut through all that noise. We're not just going to look at flashy return numbers. Nope, we're going to give you a toolkit to make some really smart investment choices.
Okay, so let's put you in the hot seat. You've got two funds. Fund A, an 18% return. Fund B, 14%. Which one do you pick? I mean, Fund A is the no-brainer, right? The clear winner? It seems so simple, but I'm here to tell you, it's really not.
And that's because, as you're about to find out, the really important stuff, it's almost always hidden just below the surface. That big, shiny return percentage, yeah, it's just not giving you the whole picture.
This right here, this leads us straight into something called the return trap. And honestly, it's one of the biggest mistakes investors make, just grabbing the fund with the highest past return and calling it a day.
I want you to think about it like this. Imagine two hikers. They both get to the same mountain peak, but one of them took this nice, smooth, steady path. The other one, they were scaling a super risky, treacherous cliff face. I mean, sure, they both got to the top, but their journeys? Wildly different. And it's the exact same thing with mutual funds. The real question you have to ask is, how did they get that return?
So how do you avoid falling into that trap? Well, you've got to look under the hood. And lucky for us, there's a solution for that. A super powerful toolkit of financial ratios.
These 5 ratios, they're like diagnostic tools for your car, but for your investments. They're going to help you understand the risk, the manager's actual skill, how efficient a fund is, and this is a big one, the true cost. They're what let you go from just guessing to actually analyzing.
All right, let's roll up our sleeves and get into it. We're going to break down each of these 5 tools, one by one, so you'll know exactly what you're looking for.
First up in our toolkit is something called beta. You know, the easiest way to think about beta is it tells you how a fund vibes with the market's mood. Is it just a chill passenger along for the ride, or is it strapped into the front seat of a wild roller coaster?
And what's great is how simple this is to read. If you see a beta of exactly 1, the fund pretty much moves in lockstep with the market. If it's less than 1, it's a bit more conservative, a little less jumpy. But if it's more than 1, well, buckle up, because you can expect much bigger swings, both up and down.
And here's some really solid advice from an expert. For most of us, a beta somewhere between 0.9 and 1.1 is kind of the sweet spot. You get to ride the market's growth, but without taking on all that extra crazy risk.
Okay, on to tool number 2, standard deviation. Now, if beta tells us how the fund dances with the market, standard deviation tells us how much it just bounces around on its own. You can think of it like a speedometer for how consistent, or inconsistent, its returns are. And this shows you the trade-off perfectly. High standard deviation, that's a bumpy ride. You might get higher highs for sure, but you could also get some scary lows. Low standard deviation, that's a much smoother and more predictable trip. So, which one is right? It really just comes down to how much of a thrill seeker you are with your money.
Okay, now we get to one of my personal favorites, alpha. This is where the human element comes in. Think of alpha as the fund manager's report card. It answers one simple question. Is this person actually adding value with their brainpower, or are they just riding the market wave?
And look, here's a super simple example. Let's say the market benchmark did 11%, but your fund manager, with all their smart stock picking, got you 14%. That extra 3%? Boom. That's the alpha. That's the value they brought to the table.
But, and this is so important, anybody can get lucky for a year, right? The real test is consistency. Just like the expert says here, you don't care about one good year. You want to see a fund that delivers that positive alpha consistently over 3, 4, 5 years. That's skill. Everything else is just luck.
All right, our 4th tool, the Sharpe ratio. This one might just be the most important of the bunch. It kind of ties everything else together. It asks one simple but incredibly powerful question. Am I actually getting rewarded enough for all the risk I'm taking? So let's circle back to that problem from the beginning. Remember Fund A and Fund B? Okay, so Fund A has the higher return, 15%. But check this out. Fund B has a higher Sharpe ratio. What does that mean? It means Fund B is way more efficient. It's giving you more bang for your buck risk-wise. And that, my friends, often makes it the much smarter choice.
And finally, let's talk about the silent killer of returns, the expense ratio. This is that sneaky little number that quietly eats away at your wealth year after year. It's the fee you pay the fund company, no matter what.
Whether they make you money or lose you money, they get paid.
And just to show you why this is a huge deal, let's run a quick scenario. Let's say you invest 5 lakh and you just let it sit for 15 years. Now let's see what a seemingly tiny difference in fees does to that pile of money.
Wow, look at that. It's kind of shocking, right? That tiny 1% difference in the fee, it doesn't sound like a big deal, but over 15 years, thanks to the power of compounding, it becomes a massive chunk of change. We're talking several lakhs, and that's money that belongs in your pocket, not theirs.
And the expert advice here could not be clearer. If you're looking at two similar funds, a lower expense ratio is a huge advantage. It's one of the few things you can control, and over the long run, it makes a really significant difference to your bottom line.
Okay, so let's wrap this all up. What's the big takeaway here? The goal isn't just to blindly pick the fund with the biggest return number next to it. No way. The real goal is to invest with confidence, knowing you've actually seen the whole picture. And now you have the toolkit to do exactly that. You've got beta to measure market risk, standard deviation to measure volatility, alpha to measure the manager's skill, the Sharpe ratio for efficiency, and the expense ratio to measure cost. This is your new checklist. Use it for every single investment you consider.
So I'll leave you with this one question. Are you going to keep chasing last year's flashy returns? Or are you ready to start building real, sustainable wealth? Because with this toolkit, you're now equipped to look deeper, analyze smarter, and make the kind of disciplined choices that will actually shape your financial future.